Everyone, this is Paul McManus, and I am here with Shane Walls with Advisor Bridge. How are you doing, Shane?
Doing great. How are you?
I'm doing fantastic. And the topic we have for today is that you do some very specialized tax strategies when it comes to helping developers eliminate the capital gains tax on their projects. Now, a lot of people are familiar with the 1031 exchange, but you actually help them eliminate the 1031, the capital gains tax. Tell us more about that.
Yeah, we do. I work with several different attorneys, and I've got one attorney in particular that has a plan that actually eliminates and not defers the capital gains tax. A lot of people see that in some of the stuff I've got out there, and they'll say, yeah, is this a 1031 exchange? And I'm like, no, it's not. I've had people say, why don't you just tell people it's a 1031? I'm like, because it's not. So we do, in all reality, it does eliminate capital gains tax. And it's not something that was invented yesterday. The planning has been around for quite some time. It has to do with the charitable piece, but you still have full control. So, basically what happens is you've got let's just say you're selling a property for $10 million, and you have to transfer your ownership into a structure, basically an LLC, that is tied to a charity in some way, but you have full control over everything. Nobody else can touch the money except for you. Charity can't touch it. What that does, it eliminates the capital gains tax. And there's three taxes this affects, by the way. There's capital gains tax, interest, dividends, eliminates all that. So even if you're not a developer, even if you're not in real estate, if a business owner is selling a business, same thing with them. I've got plenty of clients that do that, and they're trying to look for a way on these big chunks of money to eliminate the tax, and that's what this strategy is for. It also, whatever goes into the strategy, when you transfer your ownership into this newly formed LLC, you also get a tax deduction for whatever you put in there. And if it's property, it's the value of the property. If it's cash, there's a certain amount you get as a deduction, which is a very large amount of that. So you can eliminate ordinary income tax, eliminate the capital gains, and anything that's put into the structure is out of your estate. So you really minimize your estate taxes too. So we do a lot of planning around those three taxes with this one strategy.
You primarily work with very successful real estate developers, and I'm also familiar with one of the people that probably a lot of people might be familiar with that actually use this specific strategy, I understand, is a gentleman by the name of Mark Zuckerberg.
That's right. No, exactly. So that's one, there's a couple of articles on him with this type of planning, but basically what he's doing right now is he's doing it for the tax deduction side, and transferring some of his ownership each year into the strategy to eliminate the tax on it. So he's basically putting $1 billion worth of shares a year into this strategy. And his plan is to actually put all of his shares at some point into the strategy when he exits. So he's doing the same type of plan, set up structured a little bit differently than we structure ours. There's different ways to structure this, but we do it for maximum tax purposes, usually for asset sales. But when he does exit out, he's going to put all of his shares into this type of plan. And people, you read it and it says it's going to charity, but he still has full control of the money. We know how it all works, but there's all kind of different ways that people see this type of planning. But someday some money will go to charity, but we show them how to replace that money with another method. So getting into the details, that's probably as far as I'll go on that.
Sure.
But there's the other side of it is the way the IRS looks at stuff like this. And when I first started looking at it myself, I was like, wow, that's just you're getting all these tax perks, and the charity's still not getting the money. And well, they will get money someday, and that's why it works. So the government looks at this stuff; they're advocates of this type of planning. I just didn't know it. So I work with a couple other attorneys. One of them's an ex-IRS attorney that used to audit this type of planning, and he said, Shane, hey, here's the way the government looks at that. They are advocates of this type of planning because all those charitable causes that people are putting money into, getting the tax deductions, the government could never do all the stuff that they do. So as long as you follow the rules within this type of planning, which are very simple, then there's nothing they will do. They just want to make sure everybody's following the rules, and knowing that the charities someday will get some of this money is the reason that this type of planning works. And, a lot of people, it's just not something that's heavily marketed on the internet. I don't have anything on my website, but
And why is that? So I mean, I think that's the question that I hear a lot of people saying is that it's always like, if it sounds too good to be true, why haven't I heard about this before? Why haven't I seen it online? Why isn't my CPA told me about this? Why is it that because it's interesting. I mean, you and I were just at an executive roundtable for some very successful real estate developers, including one that is a billionaire, right? And the question always is why you think, why haven't they heard of this before?
and it's like any other type of planning that we do the same. We have other types of planning we do to eliminate a lot more tax than this on the ordinary income tax side of things. But it's like anything else. These different people that I work with jointly who actually set up these plans don't want this stuff heavily marketed on the internet. They don't want because it gets out into the wrong hands. Other attorneys try to copy what they're doing, and that's why they end up doing it wrong. Getting the clients in trouble, and then then the IRS starts looking at it. Not that they're going to change anything, but it just starts causing problems where there's negative. You know, when you Google it, there's all kind of negativity. Whereas now there's not. It's just it's because we keep it private, and so we don't do a lot of heavy marketing. And there's no name on the plans. You're not going to hear right now, so nobody knows really much more about it than a few of the details that I just told. So we keep it private for a good reason, and that's just really not to get it into the wrong hands of other people trying to copy what we're doing and messing it up for everybody else.
Recently, I spoke to one of your clients from Impact Developers who did this plan. Can you tell us a little bit some of the details about what his challenge was and what you did with him to, why was this plan useful for him?
Sure. Same things that other developers. He's getting into a situation where he's got about about three to four very large assets that are going to be selling from. Well, actually, one of them's already sold this year. So he was worried about the capital gains tax, and he didn't like the 1031 exchange. Too much of a pain. A lot of guys don't do them for that reason. Some guys try it. You want to do something. You wanted to at least defer it, but sometimes it doesn't make sense because there's nowhere to put the assets or the money. So in this particular case for this client, he needed the tax deduction for last year because of his fees on his developing. His developing. So he put in some cash for last year, and this year he's already put in two of his projects, and sold one. He's going to sell the other two either by the end of the year or into the next year. But he'll eliminate all the capital gains tax, or at least 99% of the capital gains tax on those two. So what he's going to do once it's in a structure, you're never taxed on that money again. So the growth is tax free. That's what I didn't cover earlier. So the growth on this, once you get it into this LLC, not only do you eliminate the tax in year one, which is a big deal. Now the bigger part of this strategy is that it grows tax free for the forever, actually up to 3 generations. So that's the key in all of this, because he saw that, the effects of that when you're putting in, $2, $5, $10 million, and you're getting the kind of returns that a lot of these developers I'm working with do. If you ever put a future calculation on that, it's a very large number, very large. So that's what we've been able to do for him so far. We're working on some other things with him now, but because his fees are starting to get higher and higher each year, so we're going to work on his ordinary income tax and get that down even further. But to eliminate the capital gains tax, so now he can buy and sell in this structure and not be taxed on anymore. And that's the key. But for this year, I've actually set up this strategy for my personal use as well, because I've become I've become an investor, and working with these developers, I've learned that I just didn't know there's actually guys out there that exist that where there's really no risk in what you're doing, and not near as much as in the stock market, and the returns are triple or quadruple or more what you get in the stock market on average. So yeah, most of my money is in different multi-family projects and condos and different things that I've met these developers. And so same thing with me, I'm finally coming up on an anniversary where we're about to sell a property, and capital gains tax is going to hit me very hard. And so now it's not. So same. I live and I practice what I preach. I always have, and and glad I can do it now.
Now, do you work just with developers in Texas, or do you work outside of Texas as well?
No, and obviously we try to brand yourself to a certain area or a certain state, but no, I've got clients all over the United States, and there are certain cities I kind of focus on now outside of Texas. Places I like to go. So so it's not limited to Texas. And I see occasionally somebody will send me a note saying, "Hey, I see that this works where your state is. I wish I'd like to learn about it because we got some projects there, but we got most of our projects in other states. So it works in any state. It's not a state type tax planning we do. It's federal. So I can work with anybody anywhere and eliminate the tax on the capital gains side of it and still affect their ordinary income tax and everything else, anywhere they live in the United States.
Do you find that most people that you start working with or that start seriously inquiring about the strategy, do they typically come to you on their own, or do they bring their CPA with them, or what's that situation like?
Most people initially find me from referrals or, some LinkedIn stuff that we do and usually come on their own in the beginning. And then I explain it to them, go through it, get the attorney involved. And then we bring on, once they get to the process where they believe in it, they really want to do it. And, some people make their own decisions. Some people bring their CPAs in, other advisors, their partners. So we welcome all that. These attorneys don't like competition. So it won't be another attorney that's like a estate planning type attorney, but CPAs are always welcome, or anybody they trust that's, that we kind of vet them out, look at them, make sure they're not some kind of competition that would want to copy what we're doing.
Sure.
But definitely they're welcome, so we like that because, most people that are at that level have advisors that they trust. And, that's sometimes like they'll ask us that and we're like, no, we'll recommend you bringing somebody in, on the vetting process. So, but the fact that we got so many people that have done it and they're willing to talk to our new prospects or new clients, and some of the big people out there that we can name off, that have done the planning and do it every year. There's plenty of credibility involved in it. So, a lot of people used to say when I first started doing this, well, that's just too good to be true. And to me too, I was like, okay, well, I didn't have all the answers back then, but now I got a lot. I don't have all the answers now, but I got a lot more than I had before, and I've got plenty of people who've done it. Now I'm doing it, so that will add to the value of what we're doing and the credibility.
What I find interesting is that because it is such a specialized strategy, right? So to your point, a CPA, it's typically not even on their radar, right? And so it's not, so a CPA doesn't know about it because it is so specialized. Would it be also be fair to say that oftentimes even other financial advisors are people that are trusted advisors to these people, because it's such a specialized approach that most people just aren't aware of that option?
Yeah, and that's almost always the case. There's very few CPAs, if any, that I've met that have known anything about it. So, and CPAs, they do their, so I've met some CPAs that get a lot more creative in certain areas because they branch out like we do, like I'm doing. I'm a financial advisor. Well, how do I get to the point where I'm at now? Well, I like the tax side of it, and I like to eliminate tax, and I like real estate. So I'm a tax and real estate advisor. I'm not a stock market, and I'm not a day-to-day looking at the stocks and choosing stocks. That's not what I do. So, for me, it's evolved over the years. And same thing with CPAs. I met some that are very basic and they just do the tax returns, which are, a lot of them do that. Nothing against that, but people that I'm dealing with are looking for a much higher level person that's willing to bring guys in like me and other guys that do what I do, where we eliminate their tax problems, which is hard to find. So no, it's not something a CPA is ever going to hardly know. I never met I have not met a CPA. I knew some that knew some charitable type strategies that were different than this one, but other than that, it's a lot of the same. They're looking for the same tax deductions every other CPA is looking for. Maybe they get a little more creative, but this is stuff that's usually outside of the scope of what they have ever even seen. So we just get involved with them. And I've taught many CPAs that I'm close to how this works, and we work together with some of their clients. So taking it on a different angle.